What's going on, my friends? Yes, I am super casual today. As you can tell, I am wearing my D-backs hat, which is better known as the Diamondbacks, and that is a basketball. So we thought that it would be a good idea to share with you a year-end kind of recap and then where we are expected to move into 2023. So with that, it's going to take a little bit extra work here, but let's dive in and look at the numbers a little closer so we can give you an idea what is going to happen, or what in theory should happen in the first couple quarters into 2023 with regards to the mortgage interest rates and housing before. But the CPI, or Core CPI, which is the consumer price index, the core part of that strips out food and energy for a number of different reasons, which you can read in my show notes below if you care to know that much. But ultimately, the CPI, if you look at the numbers or the chart here, you will notice that the CPI has followed the mortgage interest rates pretty darn closely. So looking at using the CPI for future in terms of what is to be expected is a good indicator. So let's dive a little bit further, but looking back, we can see in the numbers that in from 2018 in the charts all the way through to just about early COVID, the CPI and the mortgage interest rates almost were like followed each other, right? There's that anomaly period that happened in there, and that was partially or largely due to COVID and stimulus money that was injected, in addition to a number of different other things, some of which we've talked about, which is do the feds think that inflation was transitory, meaning is it real or not, if you will? And in fact, it was. So there was a moment where money was still being thrown into or injected into these numbers, which kind of falsely threw them off a little bit because the feds were still buying mortgage-backed securities, keeping those rates low when inflation was really starting to tick up. And then that's why we saw a very large increase very fast in a number of different things. So one of the questions is, when will inflation peak? Now, it has been discussed many times that by myself and a number of different others, in the industry and by the media even, that the interest rates or the inflationary numbers have peaked. Now, if that is the case, that is a positive. And if we're still going to be seeing an uptick in inflationary numbers, then so be it. However, what we have to also consider is when we know that we look at the CPI to determine what the inflationary numbers are looking like, but the CPI takes into other figures or factors like, again, we strip food and energy out, or the core rate. But if we look at shelter costs, which is comprised of roughly 40% or near 40% of the entire CPI, but rents or shelter is lagging by a 12-month factor, that the numbers are skewed dramatically. So what we're seeing is what appears to be better, but is really not. So you're probably hearing that rents are starting to fall. There's more vacancies occurring. People typically sign a year lease, so that lease is going to be up, and then are they going to renew? Is the landlord going to lower that cost, because the demand for that same house or apartment or whatever it may be has dropped. Now, as the real numbers, year over year start to come into play, and we will start to see that shelter factor in the CPI start to lower, in which case the inflationary numbers lower, and thus the mortgage interest rates lower as well. Now, for years, I have followed the 10-year Treasury bond to determine what the 30-year fixed rate loan is going to do. The spread between the 30-year fixed mortgage and the 10-year note has roughly, for nearly 25, 30 years, been about 2% now, or a little less. So it's been a good indicator of what the rates are doing. So typically somebody may go and look, or consumer may go and look at the 10-year and go, oh, I heard the 10-year is doing really good. Does that mean that the interest rates are better or worse, right? All depending whether or not that bond is up or down. Now, for that very long period of time, the spread between the 30-year and the 10-year was pretty consistent up until the beginning of 2023. Now, the reason for that spread or increase going from roughly 200 or 2% or 200 basis points to 300 basis points or 3% is largely in part due to the massive increase in the interest rates, to the point of we have to think who is servicing the notes, the mortgage notes that are held by those higher interest rates, 6.75, 7.25%, right? Is the consumer going to continue to pay interest to that note holder as the interest rates fall into 2023 and beyond? No, they're not. They're going to bail out. So the value associated with the note is much less. So the spread between the 10-year and the 30-year are bigger. So again, the 10-year is a good indicator of where the 30-year fixed note is going. The next question is a recession coming? Now, typically we're not going to know if a recession has landed or officially if we're in it until about 6 to 12 months until we're out of it. Why? Because the feds don't indicate that we're in a recession until it's already over, right? So it's like, yeah, we experienced the recession in the tail end of 2022 and the beginning of 2023 is likely what's going to be expected. So all of the increased costs, all of the equity line increased payments, all of the interest rate increases on, not on the mortgages, in addition to your consumer debt, like revolving debt, credit cards, things like that, all of that extra cost is going to fall. But we're seeing the peak of it, what we anticipate being the peak, are very near to the peak of that this year and to the beginning of 2023 a little bit. So the question whether or not a recession is going to come or not is inevitable. And remember, as we get into a recession, that as we enter or are in a recession, mortgage interest rates will fall. Some indicators to determine whether or not we are in a recession or not are some of these things. So for example, are consumers spending more money on credit cards? If the answer is yes, then that is one indicator. And we can see that there is a massive increase in credit card spending because that is trackable, okay? So one of the other questions that comes up is, are we expecting a crash? Now, the likelihood is very slim, my friends. I've talked about this many times over the year, and I know that there are a lot of doom and gloomers out there, and trust me, I know that things do not appear to be perfect, and they are far from it, right? We shouldn't have got to the point we're at. The Fed should have been tapering the purchase of mortgage-backed securities. The inflationary numbers have risen super high. We saw massive increases in the housing market, which shouldn't happen, but nobody would have anticipated COVID happen either. So, in theory. And I won't get into that, and I won't talk about that too much because we're going to try to stay away from the political side of this. Big question as to whether or not the housing market will see a crash. The likelihood is super low, my friends. The market appreciation over the last 10 years is over 115%. Yeah, while we saw a massive increase through COVID, where market appreciation year over year was anywhere between 15 and 20%, that's huge, right? So $500,000 loan or home is now at a 20% appreciation year over year, is seeing a $600,000 value, a $100,000 increase. It's not sustainable, which is why the inflationary numbers are part of the reason inflationary numbers were so high. Rents are high, etc. Now, the concern is what's going to happen with all that appreciation? Is it not real? Was it not real? Is it going to fall off? The likelihood is very slim. we are still seeing an uptick in appreciation. Though recent, we've seen a slight fall of roughly about 2 to 3%, but that's because of the interest rates being so high. So once again, as these CPI figures start to fall, right, which is an indicator of what inflation is going to do, the interest rates will fall, thus increasing the demand to the housing market and normalizing it once again. So normal household formations year over year have been about 1.75 million per year. Now through 2023, we're seeing only about 1.2 million. And the biggest reason, as we know, is there's a lot of people sitting on the fence, right? So when we talk about household formations, one of the questions is, what is that? Household formations are, you have a child who leaves the house, this is an example, who leaves the house and goes and buys their own home. That is a household formation. So once again, as I mentioned, we're seeing a pretty big decline. As the interest rates start to fall, the market starts to normalize, we get some of these people off the fence, which they will. It will happen, right? Because as you see the payment difference in the comfort level, and not to mention, as inventory starts to pick up a little bit, demand will pick up, interest rates lower, the cost or affordability to be able to purchase is much better. So a little bit more around affordability. The likelihood of a crash, as you can tell, is very, very slim. Now, for those of you that think otherwise, feel free to comment and I'll respond accordingly. I know that we don't have the crystal ball. Nobody does. But there are too many indicators pointing to the market coming back around. So we should be fine. And the market hasn't even gone to some place that's nasty, right? The housing market and the appreciation factors are still good in the housing world. So in regards to affordability, a couple things. We see that the affordability has increased, right? So if we're seeing, let's say, a year over year 10% increase from last year to next year, which is likely probably going to be a little less than that. It might be even flat, and it might be negative a little bit. By a little bit, I mean less than probably 2%. That it will start to turn back around. So year over year, I think this time so December to December, we're probably going to see about a 5 to 10% increase. That's my anticipation. But let's say that we do. So 500,000, 10% increase, that's 550, right? So you're seeing or let's use the example that we showed in the illustration actually. So it's 400,000 at a 10% increase, it's 440. So where, let's say a year ago, interest rates were 3.5, we're seeing about 6.25 now, roughly. It's a little bit more than that. Okay, my friends. So once again, back to affordability. As we roll into 2023, into the first and second and probably third quarters, and we see a fall in the interest rates and the corresponding difference in payment is that much better, there is going to be a comfort level that is going to get a very large portion of people off the fence to purchase again. To get back to that normal 1.7 and some change million household formations per year compared to that of like 1.2. The other thing that wasn't or hasn't been taken into consideration, even though a lot of people were waiting to purchase, is that the majority of people saw an increase to their household income, right? It's different when you know you have an increase in income, but you have not experienced how to manage it or spend it or what that's going to translate to in terms of your monthly budget, right? And how it's going to feel. But when you know something is going to cost more, the inherent nature is to, I hate to say it, but to complain, right? Like it sucks that gas is so expensive. It sucks that credit cards are so expensive, all of that stuff. But with all of this, we have to take into account that the household income has increased by probably 8 to 9% year over year. Now, as rates start to come down in 2023, household income continues to rise, interest rates come back down, yada, yada, yada. We're going to see, again, the household formations continue to increase and the market crashing to be super unlikely. So let's recap, my friends. If you look at the show notes below, the discussion items that we talked about. So in regards to housing, the bullets, we talked about lower inflationary numbers, right? That's going to help. Recessionary numbers slowing down. Income expected to increase to help affordability. A little bit tighter inventory. It's not great, but it will affect housing. And rents are expensive and rising, though we are seeing a slower rise, if you will, with regards to rents. Now, in regards to interest rates, the headwinds that we're seeing are global quantitative tightening, a lack of foreign central bank buying, which we talked about earlier in our discussion. And then our tailwinds come from behind. We got lower inflation, excessive retail inventory, increase in servicing value, recession likely, again, as we discussed. And again, the big thing here is, as we go into recession, just remember that rates have a tendency to be lower. So with that, my friends, that is our expectation of what the market's going to do. Don't be all doom and gloom. For those of you sitting on the fence, don't be afraid to jump off and into the waters. Get your toes wet, jump in full board, whatever you need to do. But we look forward to seeing you and hearing from you into 2023, because I can guarantee that the housing market is going to be strong. Did I say guarantee? Maybe not. All right.